Ever heard you need to invest to get rich and dream of never having to work again, but felt lost on where to start? Picture this: your money not just sitting, but actively growing for you. It's not just about the size of your paycheck, it's about what you do with it. Today, I'm unveiling 5 avenues to help you quit your job faster. Stocks, real estate, businesses, cryptocurrencies, and gold, along with the right strategies to approach each. If you take the right steps, your money can be more than just paper you exchange. It becomes a powerful tool. The wealthiest? They aren't grinding away hours for a flashy car or a grand mansion. Take a page from Warren Buffett's playbook with his golden rules. Never lose money. And remember rule number 1. The affluent use money to buy assets, which in turn generate more income. It's a seemingly elusive game where money works continuously. Imagine lounging on vacation while the cash still flows in. But here's the catch: most of us are stuck in a loop, working hard just to splurge. To truly be wealthy, shift gears. Think assets, not expenses. Let's say next time you dream of a lavish trip, instead of emptying your pockets, your assets cover it. Want to transform this into reality? Let's dive in, starting with stocks. What if we told you you could begin your investment journey by buying stocks with just $100? Sounds shocking, but that's actually right. Given how cheap it is, many beginner investors often troop into the market without knowing its tricks. As a beginner, you need to first get your money in order. You need to know what you earn and what you can spend. Secondly, you need to understand people invest in shares not because of the short-term benefits, but because they expect the company to grow and make profits over time.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
It's all a waiting game. You need to be patient for whatever return you get on your investments over time. Never panic when the market is shaky, as you can make lots of mistakes by acting in haste. The stock market is strictly long-term, and believe it when we say prices will rise and fall at different times. Thirdly, never forget to set limits. Apart from analyzing your finances, you should be setting limits based on how much you're willing to lose and expect to gain. If you handle all of these right, your rewards can be juicy. Your investment can grow anywhere from 7 to 10% over the long term. Think about this. If you invest $10,000 in the stock market today, and it gains around 7% per year, you'd have doubled that investment in 10 years. How about a longer-term example? On average, the S&P 500, which has 500 of the largest publicly traded U.S. companies, has shown an average annual return ranging from 8% to 12%. With that in mind, an investment of just $10,000 in the stock market in the 70s could have given you over $380,000 today.
Let me give you a figure that'll blow your mind, I think. I bought my first stock when I was 11 years old. It was the first quarter of 1942. I spent $114.75. 3 shares, $114.75. If I put that 114 into the S&P 500 at that time and reinvested the dividends, think of a figure as to what it would be worth today. Oh man.
However, it's important to remember that the stock market doesn't march upward every year. On average, the S&P 500 usually falls in about 3 out of every 10 years. But the beauty of investing in the stock market lies in the fact that when you buy a share of a stock, you're actually getting fractional ownership in a company. Your investment allows you to own a small piece of the company whose products or services you admire. And what could be more satisfying than that? Additionally, most stocks trade publicly on a major stock exchange, making it easy to buy and sell them. This makes stocks more liquid than other options like real estate investments, which you can't quickly sell. One of our favorite stocks to invest in is, ironically, Buffett's Berkshire Hathaway's largest holding, a stunning $162 billion worth of Apple stock.
Apple is different than the other businesses we own. It just happens to be a better business than any we own.
It's not surprising to see Buffett praise Apple. The company has a loyal customer fan base thanks to its reliability, luxury, and quality. Just take a look at the iPhone. All of these allow Apple to continually demand higher prices for its devices, which only increases its profits. With over 2 billion active devices and over 1 billion paid subscriptions, Apple is set to make lots of revenue for years to come, perfect for long-term investments. One benefit business investments have over the stock market is that while the latter can give you 7 to 10% return on investment every year, which is great in the long term, you could be getting multiples of that if you run a business. But that can be tricky. You need to know how you want to grow, the plans to succeed, and most importantly, have passion for it. Remember Buffett's famous quote, "Never invest in a business you cannot understand"? It's important to hold his words dear. Here's what Mark Cuban, another billionaire, had to say about starting a business.
What would be your biggest advice to an entrepreneur, somebody trying to start a business?
Well, first know your business. And if you don't know, you're not ready. You've got to have something that you're good at. If you're going to do it, you got to be the best at it. You've got to work like there's someone working 24 hours a day to take it away from you.
Luckily, if you don't think you can run a business, there is a solution. You can put your money into startups instead. Now, this is a higher risk, higher return strategy. As with all investments, there is always a risk of failure. But if it doesn't, not only will your portfolio be diversified, but also it would be rewarding. We are talking about the potential to give you profits over 10 times your original sum. When investing in startups, though, you should consider investing in about 5 to 10 of them to prevent putting all of your eggs in one basket. Let us assume across a portfolio of 10 investments, only 2 or 3 of them failed. Your profits would be more than enough to make you forget about them. On the flip side, even if only 3 succeeded, did you know the profits would still outweigh the disappointment? As if that wasn't enough, when you put your money into new businesses, you create impact. In 2020 alone, startup businesses created over 3 million jobs. Additionally, startups usually create products and services that can solve problems. When you invest in such, you are supporting innovations. That said, apart from the risks that come with these, startup businesses cannot be traded like stocks. You can't just cash out your investments unless the business goes public or it gets acquired. Before we round up, as an investor looking into startups, you must study its industry and the market conditions. You can't afford to get bigger firms as a competitor. Also, take your time to consider the company's financial records. The more information you have, the better your decisions will be. Now, if you aren't willing to risk the possibility that if a company fails, you will be losing all the money you invested in, here is another good option for you. Did you know that some stocks pay you just to hold them? Yeah, you heard that right. It's that easy. Whenever we think of trading, the strategy for success we tend to believe in is buying cheap and selling when it's expensive. While that can be true, dividends are different. And if you haven't considered investing in them, you need to. For someone like Warren Buffett to constantly praise it, don't you think you're missing something?
Well, the answer is I do believe in dividends in a great many situations.
Dividends are like companies sharing their profits with investors. They do this by giving them money or more company shares regularly. Imagine getting paid without having to move a muscle. The good thing about dividends is that it has a history of doing well, even better than the S&P 500. It has a lower risk than traditional stock trading. How about a practical example though? Imagine you buy 100 shares of a company for $100 each. Each share gives you $5 every year as a dividend. If you put in $1,000, you would get $500 in a year. That's like getting 5% of your money back as a bonus. Not bad at all. And whatever you choose to do with your bonus is all up to you. You can use it to buy more shares, invest in another company, keep it in your piggy bank, or spend it how you please. Last, this is one important thing to note. Never go for the biggest bonuses. Always consider the company first.
When I was 11, I picked stocks. I had the whole wrong idea. I thought stocks were things that went up and down, and I charted them. I read books on technical analysis. I read everything. And I thought the important thing was to predict what a stock would do and predict the stock market. And then I read Ben Graham, and I realized that I was doing it exactly the wrong way when I read the book, The Intelligent Investor. And from that point, I never bought another stock. I bought.
People who are new to investing often go for the bigger bonuses. They just take a quick look and buy whatever stocks that have the highest yield. While that isn't exactly bad, think of it this way. Imagine you walk into a store that sells ice cream very cheap. Would you buy it for your kids without thinking? It could be because it's spoiled or it's just inferior. All that glitters isn't always gold. As a newbie, don't just pick stocks because they have the biggest bonuses. If one company's bonus is much bigger than others, it might be in trouble. Also, look at the payout ratios to see if the bonus can last. And just as importantly, check how the company has been giving bonuses in the past year and if they're growing over time. Before we go into the top 2 on our list, here's a question. What would you say the prior investments all have in common? That's right, they're all intangible, a key difference from real estate. Investing in things like stocks or bonds is like having a piece of paper that says you own something. But the truth is, if the stock market crashes, that paper would hardly be worth anything. Real estate, on the other hand, is real and can be touched. Yes, its value can appreciate or depreciate just like stocks, but it is safer and steady. It is worth adding that selling real estate takes more time than stocks, given you'd have to find a buyer that meets your valuation and then go over all the legal fine print. But it is worth it.
This here is real silver, plata. Okay? That's what it looks like. And so in 1972, and this here is gold.
Yeah.
This is God's money.
Did we forget to mention the fact that its value can be appreciated in a surreal manner? For example, if you bought a house for $300,000 in 2011, it might be worth a whopping $750,000 today. That's more than double what you paid. Who wouldn't love that? But wait, there's more. Real estate can also bring in money regularly, like a side job. This is called cash flow. It's like getting paid rent from people who use your property. It usually depends on the area, the kind of building it is, and other factors, but just like dividends, you can expect lots of money at specific intervals in a year or some months. And as if that wasn't enough, did you know real estate can cause nice tax breaks? Yeah, real estate investments can offer various tax benefits, such as deductions for mortgage interest and depreciation. You can deduct the costs of owning, running, and managing your property from the taxes. Plus, you can reduce your taxable income by spreading out the cost of buying and improving a property over many years. So, you pay less in taxes, which means more money in your pocket. It's like a win-win. The best investors already know this, and they have been taking advantage of it.
They're the businesses that you buy once, and then you don't have to keep making capital investments subsequently. So you do not face the problem of continuous reinvestment involving greater and greater dollars because of inflation.
There is a saying that you should never bet against gold. For years, it has been the gold standard, no pun intended, of investments.
Let's say I make $1 million. I don't want to pay tax on that. So I take that $1 million, instead of spending it on something stupid, I buy a piece of real estate, so let's say for $5 million. So I go from $1 million to $5 million. Then I appreciate, depreciate, and amortize that $5 million, and it offsets my $1 million in tax.
It shouldn't be surprising to hear Kiyosaki refer to gold as God's money. It is a precious metal valued for thousands of years because of its historical importance and stability. Today, even the best investors would tell you to get it over stocks.
The other thing I recommend to people is buy gold, silver, the physical, not the ETF shit. because the moment you have gold and silver, there's no counterparty risk.
One reason why gold is so trusted is that the economy itself believes in it. When regular cash doesn't work, gold is plan B. Hey, remember that time when the US dollar dropped from 1998 to 2008? People turned to gold, making its price go up. For just under $300 for an ounce, its value flew right to over $2,000. Whenever inflation fears rise, no one panics about gold having a collapse. As a matter of fact, over the past 5 decades, when inflation went up, gold rose as well. In recent years, buzzing economies like India and China have increased their demand for gold, especially for the former, who sees gold as a part of its culture. Everyone uses gold jewelry over there, and during October, a period famous for its weddings, expect a rise in demand. In a nutshell, gold isn't the average metal. It is timeless, stable, tangible, and has a lot more perks than cons, if it has any at all. Here's a parting word from Kiyosaki again.
You don't buy gold coins to make money. You buy gold coins because the dollar is going to go down. I don't trust the dollar. For most of my life, I've saved gold and silver. That everybody can buy a $20 silver piece. Everybody can afford 20 bucks. Will they do it? No. They'll be at Starbucks sucking it down instead.
Now, remember, these are only options, and there is no such thing as instant success. Investing always comes with risks, so be cautious and only put in what you can afford to lose. In the wise words of Warren Buffett, successful investing takes time, discipline, and patience. Just like you can't rush the process of creating a baby, some things in the world of investments also require time. So take your time, make smart decisions, and stay patient.